The real battle is inside your head. It's happening inside your head. And most people will never go there. Not because they can't, because they don't want to. Because looking inward, truly looking at why you make the decisions you make with money, is uncomfortable. It's vulnerable. It forces you to confront things about yourself that you'd rather ignore. But I'm not going to let you ignore it, because this is the part that actually saves you. Everything I told you before, the framework, the position sizing, the rules, all of it is useless if you can't win this battle first. So let's go there. Let me take you back to the beginning, back to David. Remember David? The disciplined investor. The man who spent 15 years building wealth the right way. The man who watched his neighbor and his colleagues make fortunes in crypto. The man who eventually put 30% of his net worth into a market he didn't fully understand, and lost most of it. I told you earlier that David's mistake wasn't that he bought crypto, and it wasn't that he didn't understand the market mechanics. He had read, he had researched, he had done more homework than 90% of the people making money in crypto. So what was his real mistake? His real mistake was that he didn't understand himself. He didn't understand the invisible forces inside his own mind that were quietly, systematically destroying every rational decision he had ever made. And those forces have names. The first one is called FOMO. Fear of missing out. You've heard this word 1,000 times. It's become almost meaningless because people throw it around so casually. Oh, I have FOMO about this restaurant. Oh, I have FOMO about that vacation. But in the context of money, in the context of watching other people become wealthy while you sit still, FOMO is not a casual feeling. It is a weapon, and the crypto market wields it masterfully. FOMO doesn't feel like fear. That's the trick. When you're in the grip of FOMO, it doesn't feel like you're afraid. It feels like clarity. It feels like you're finally seeing something that everyone else has been seeing for a long time, and you're just now catching up. It feels like intelligence. But it's not intelligence. It's panic dressed up in a suit. David felt it every single day as he watched those numbers climb. He didn't think, I'm afraid of missing out. He thought, this is obvious. This is the future. Everyone who isn't buying right now is going to regret it. That feeling of obviousness, that sensation that the decision is so clear it practically makes itself, that's the moment you are most in danger, because the market doesn't care about what feels obvious to you. The market only cares about where money flows, and by the time something feels obvious to you, by the time it feels like a certainty, the smart money has usually already moved on. You are not catching the wave. You are arriving at the beach just as the wave pulls back into the ocean. The second force is even more dangerous than FOMO. It's called loss aversion. Loss aversion is a psychological principle that says humans feel the pain of losing something twice as intensely as they feel the pleasure of gaining the same amount. Think about that. If you make $1,000, you feel good, happy, grateful. If you lose $1,000, you don't just feel bad, you feel devastated, angry, sick. The amounts are identical, but the emotional weight is completely different. And here's how loss aversion destroys people in crypto. When your investment is going up, everything feels fine. You're patient, you're calm, you're disciplined. You can wait. You don't need to do anything, but the moment it starts going down, the moment that green turns to red, something shifts inside your brain. Panic creeps in, quietly at first, then louder. And suddenly, selling feels like the only rational option. I need to cut my losses. I need to protect what's left. I need to get out before it gets worse. But here's the cruel twist. In many cases, not all, but many, the worst time to sell is exactly when you most desperately want to. The bottom of a market crash is the moment when the most people are selling. It's the moment when fear is at its highest. It's the moment when every headline is screaming that crypto is dead. And it's often the moment when the best opportunities actually exist. But you won't see that opportunity. Not when your brain is flooded with the pain of loss. Not when every cell in your body is telling you to run. This is why the smartest investors in the world don't just have smart strategies. They have psychological discipline. And psychological discipline is not something you're born with. It's built. Deliberately. Painfully. Over time. I didn't have it when I was young. I told you about 1982. I told you about the bet that almost destroyed me. That wasn't a failure of analysis. It was a failure of self-mastery. I didn't understand my own biases well enough to guard against them. So I spent years studying myself, not just markets, myself, my patterns, my triggers, the specific emotions that made me deviate from logic. And I built systems, not just for managing money, for managing my own mind. Because here's what I learned, and this might be the single most important thing I will ever tell you about money. The market is not your greatest enemy. You are your greatest enemy. You are your greatest enemy. The market is just a mirror. It reflects back whatever you bring to it. If you bring fear, the market amplifies your fear. If you bring greed, the market amplifies your greed. If you bring discipline, the market rewards your discipline. But if you bring chaos, if you bring confusion, emotion, and a desperate need to get rich, the market will take everything from you. Slowly at first, then all at once. David brought chaos, not intentionally. He didn't know he was bringing chaos. He thought he was bringing strategy. He thought he was bringing research. He thought he was bringing confidence. But underneath all of that, underneath the research and the confidence and the plan, there was something David had never confronted. There was a wound, not a physical wound, an emotional one. David had spent his entire life watching other people succeed faster than him. His brother, his college friends, his neighbors. People who seemed to move through life with an ease that David never felt. And somewhere deep down, so deep that David himself couldn't see it, he believed that he was falling behind. That belief didn't live in his conscious mind. It lived in his gut. And crypto woke it up, because crypto didn't just offer David money. It offered him something far more powerful than money. It offered him proof. Proof that he wasn't falling behind. Proof that he could win. Proof that he was just as capable, just as worthy, as everyone else who had ever made him feel small. And that need for proof, that invisible, unspoken hunger, is what made David abandon every rule he had ever set for himself. It's what made him go from 2% to 30%. It's what made him ignore every warning sign. It's what destroyed him. And here is the terrifying part. David is not rare. David is everyone. Every person who has ever chased crypto, or any speculative asset, with more than they should have. There is a David inside them. A wound that hasn't healed. A belief that hasn't been confronted. A need that money has promised to fill but never actually can. Money cannot heal a wound inside your chest. It never has. It never will. And until you understand that, until you sit with that truth and let it settle into your bones, no framework, no strategy, no amount of research will protect you from yourself. So here is what I want to leave you with. Crypto is not going away. The technology is real. The disruption is real. The opportunity, yes, there is a real opportunity buried underneath all the noise and manipulation and hype. That is real too. But the opportunity is not for everyone. It is for the people who have done the hardest work first. Not the work of finding the right coin. The work of finding the right version of themselves. The people who will win in crypto, the people who will not just make money, but actually keep it, are the ones who have looked in the mirror and asked the brutal questions. Why do I want this? What am I actually trying to prove? What am I afraid of? What would I do if I lost it all? And could I survive that? Not financially. Emotionally. Could I survive it? If you can answer those questions honestly, if you can sit with the discomfort of those answers, then you are ready to play this game. Not before, because the market will test you. Not once, not twice. It will test you over and over again until it finds the crack, the one weakness, the one emotion, the one belief that you haven't dealt with. And when it finds it, it will break you through it. That's not a threat. That's a promise. So before you buy another coin, before you open another app, before you put $1 more into something that promises to change your life, change yourself first, because in the end, after all the analysis, all the strategy, all the frameworks in the world, the only thing standing between you and financial destruction in crypto is not the market. It's the person looking back at you in the mirror. Know that person, understand that person, master that person. And then, and only then, you might just be ready to play. And that's where we're going next. The wake-up call. I watch smart, disciplined people who never made a reckless financial decision in their lives, lose everything in crypto. Not because they were stupid, because they didn't understand what they were actually buying. Let that sink in. These weren't kids in their dorm rooms throwing Robinhood money at meme coins. These were professionals, engineers, lawyers, people who had spent decades building wealth the right way. Slow, steady, deliberate. And crypto ate them alive. I spent my entire career studying markets, real markets. The kind that move trillions of dollars. The kind that crash economies and make governments sweat. I've seen bull runs that defy logic. I've seen crashes that rewrite history. And in all of that, in 50 years of watching money move, I have never seen anything work on people's minds quite like crypto. Not stocks, not real estate, not gold. Crypto. Because crypto doesn't just move your money, it moves your mind. I want to tell you about a man I know. I won't use his real name. Call him David. David was the kind of investor I respect. Quiet. Patient. He didn't follow trends. He didn't care what was hot on Twitter. He had a system. A real, disciplined system. And for 15 years it worked beautifully. Then 2020 happened. You remember what happened in 2020. The world shut down. Markets crashed. Governments printed money like it was going out of style. And out of nowhere, out of absolute nowhere, crypto exploded. Bitcoin went from $8,000 to $60,000 in less than a year. 60,000. David watched. At first he did what a disciplined investor does. He said no. He held his ground. He stuck to the plan. But here's what nobody warns you about. The plan started to feel stupid. Every single day, David watched people around him, people he didn't consider particularly smart about money, making life-changing returns. His neighbor bought Ethereum on a whim and tripled his money in 3 months. A colleague at work put $10,000 into some coin David had never heard of and turned it into $140,000. $140,000 from $10,000 in 3 months. Now, put yourself in David's shoes. You are a disciplined man. You are a smart man. You have spent 15 years doing everything right, and you are watching people who do everything wrong, by your own standards, become wealthy overnight. What does that do to your brain? I'll tell you what it does. It plants a seed, a tiny, quiet, dangerous seed. And the seed doesn't say, abandon your principles. No, it's much smarter than that. The seed says, maybe this is different. Maybe this one time the rules are different. Maybe this time. That phrase, those 3 words, they are the most dangerous words in the history of investing. I have seen them destroy fortunes. I have seen them bring down hedge funds. I have seen them turn brilliant minds into reckless gamblers overnight. Maybe this time? David started small, a little here, a little there. He told himself it was just an experiment, a controlled test, a tiny percentage of his portfolio. Nothing serious. But here's the thing about crypto. It rewards you. At first, It rewards you so fast and so dramatically that your brain doesn't just accept it. Your brain becomes addicted to it. Think about that word, addicted, because that's exactly what it is. The dopamine hit of watching a number double, then triple, and quadruple. It's not investing anymore. It's closer to pulling a lever on a slot machine. Except the slot machine is paying out. And when the slot machine keeps paying, you don't question it. You just keep pulling. David kept pulling. What started as 2% of his portfolio became 5, then 10, then 20. And each time he added more, he told himself the same thing. I know what I'm doing. I understand the fundamentals. This is calculated risk. But it wasn't calculated. It was comfortable. And comfortable and calculated are two very different things. I know this because I've made the same mistake. Not with crypto. I came to crypto later, with my eyes wide open. But early in my career, I made bets that felt calculated but were actually emotional. And the market punished me for it. Brutally. The market always punishes you for it. Every single time. So here's where David ended up. By late 2021, he had moved roughly 30% of his net worth into crypto, a mix of Bitcoin, Ethereum, and a few other coins his research told him were solid. And then, quietly, then suddenly, everything changed. The crash didn't come with a warning. It never does. One day the numbers were green. The next day they were red. And within weeks, David watched 30% of his net worth vanish. Not shrink, not dip, vanish. He lost more money in 6 weeks than he had made in the previous 5 years of disciplined investing. 5 years. Gone. In 6 weeks, now. I could end this story here. I could let it sit as a cautionary tale and move on. But that would be too easy. And easy answers are how people keep making the same mistake over and over again. Because here's what I need you to understand. David's mistake wasn't that he bought crypto. David's mistake was that he never truly understood what crypto is. And most people, right now, today, as you're listening to this, are making the exact same mistake David made. They're buying something they cannot explain. They're putting real money into an asset they cannot define. And they are doing it with complete confidence. That confidence? It's not knowledge. It's hope dressed up as a strategy. And I am about to show you the difference. Because once you see what crypto actually is, once you strip away the hype, the headlines, and the noise, everything changes. The way you think about it changes. The way you approach it changes. And most importantly, the way it controls you, that changes too. So stay with me. Because what I'm about to tell you next, most people in finance will never say it out loud. What crypto actually is and isn't. Most people in finance will never say it out loud. So I will. Crypto is not an investment. Not in the way you've been taught to think about investments. Not in the way stocks are investments. Not in the way real estate is an investment. Not even in the way gold is an investment. Crypto is a bet. A pure, naked, unfiltered bet on whether the world is going to change the way it moves money. That's it. That's the whole thing. And there is nothing wrong with making that bet. I've made it myself. But the moment you call it an investment, the moment you dress it up in language that makes it feel safe, you are lying to yourself. And that lie will cost you. Let me show you why. When you buy a stock, a real stock, in a real company, you are buying a piece of something that exists, something that makes money, something that has employees, products, customers, and revenue. Apple makes iPhones. They sell billions of dollars worth of them every single year. When you own Apple stock, you own a tiny slice of that machine. The machine produces value, and over time, over real, patient time, that value grows. That's an investment. When you buy a piece of real estate, you buy something physical, something that people need. People need shelter. People need space to live, to work, to build businesses. Real estate produces value. It generates rent. It appreciates because demand for space is permanent. That's an investment. Now, when you buy Bitcoin, what are you actually buying? Think about it. Really think about it. You are not buying a piece of a company. Bitcoin has no company, no employees, no products, no revenue, no earnings report, no CEO sitting in an office making decisions about the future. You are not buying a physical asset. You cannot touch Bitcoin. You cannot hold it. You cannot live in it or use it to manufacture something. You are buying a belief. You are buying the belief that other people, in the future, will assign value to this thing. That's it. The entire value of Bitcoin, every single dollar of it, comes from the collective agreement that it is worth something. Now, before you push back and say, "But Ray, gold is the same thing," let me stop you right there. Gold is not the same thing. Gold has been a store of value for 5,000 years. 5,000. Across every civilization, every empire, every currency collapse. Gold survived them all. It has industrial uses. It has cultural significance. It has a track record that spans the entire history of human civilization. Bitcoin has been around for 15 years. 15 years. I'm not saying Bitcoin is worthless. I'm saying you cannot compare 15 years to 5,000 and call them the same asset class. That's not analysis. That's wishful thinking. So what is crypto really? Crypto is a speculative asset. Speculative. That word makes people uncomfortable. It sounds risky. It sounds dangerous. But that's exactly what it is. You are speculating. You are guessing, with money, that the future will look a certain way. And here's the part that will really make you uncomfortable. You are not the only one guessing. Everyone in the crypto market is guessing. The traders, the developers, the venture capitalists, the influencers with millions of followers, all of them guessing. The difference between you and them? They know they're guessing. You think you're investing, and that difference, that single, subtle shift in how you see what you're doing, is the difference between people who survive crypto and people who get destroyed by it. Let me give you an analogy. Imagine you walk into a poker game, a high-stakes poker game, millions on the table. You sit down, you look around. Some of these players have been playing for decades. They know every tell, every pattern, every psychological trick in the book. Now, you are a smart person. You are disciplined. You've done your research. You read 3 articles about poker strategy before you sat down. But here's the thing. The experienced players at that table aren't playing poker the way you think they're playing poker. They're not just trying to win the hand in front of them. They're trying to make you lose yours. That is the crypto market. Every single day, the people with the most money, the most information, and the most experience are not just trying to make money for themselves. They are actively, deliberately trying to take money from you. And they are very, very good at it. But I'm getting ahead of myself. That's a conversation for the next part. Right now, I want to talk about something even more dangerous than the market itself. I want to talk about what the market does to your brain. Because here's something I learned early in my career that changed everything about how I approach money. The market doesn't just move money. It moves emotions. And emotions move decisions. And decisions move your entire financial future. Think about the last time you saw a number go up. Any number. A stock. A crypto price. Your bank balance after a raise. That feeling in your chest when the number went up. What was that? It felt good. It felt really good. Now think about the last time a number went down. That sick feeling in your stomach. That tightness in your chest. That voice in your head that whispered, "You're losing. You're falling behind. Everyone else is winning, and you are losing." That feeling? That's not information. That's not data. That's not logic. That's dopamine. And dopamine is not your friend when it comes to money. Dopamine is the chemical in your brain that makes you chase reward. It floods your system when something good happens, and it makes you desperate to make that good thing happen again, and again. This is why gambling is so addictive. And here's the terrifying truth that nobody wants to say out loud. Crypto is designed, whether intentionally or not, to trigger that exact same response. The prices move fast, faster than almost any other asset class on the planet. And when they move up, they move dramatically. A 10% gain in crypto can happen in an hour. In stocks, that might take a year. In real estate, that might take 5 years. But in crypto, it takes an hour. And your brain? Your brain doesn't care about the timeline. It just cares about the reward. So you come back. You check the price again. You buy a little more. The number goes up again. More dopamine. More buying. More checking. More buying. Until one day, you look up and realize you have put far more money into this than you ever planned to. This is not a character flaw. This is biology. Your brain was not built to handle assets that move this fast. It was not built to make rational decisions when dopamine is flooding your system. And the crypto market, whether by design or by accident, is a perfect machine for triggering that response over and over again. David knew this. In theory, he understood it intellectually. He had read about behavioral finance. He understood the concept of emotional decision-making. But understanding something in your head and feeling it in your gut are two completely different things. And crypto doesn't care what you understand in your head. It only cares about what you feel in your gut. So here's where I need you to stop and ask yourself something honest, brutally honest. If you can't explain what you own in 3 clear sentences with no buzzwords, no hype, do you actually own it, or does it own you? Because right now, most people in crypto are not owners. They are the owned. And in the next part, I'm going to show you exactly how that happens. Not by accident, not by bad luck, by design. The hidden rules of the game, by design. Let that word sit with you for a second. Design. Because what I'm about to tell you is not a conspiracy theory. It's not speculation. It's not some bitter guy on the internet who lost money and wants to blame someone else. It's how the game actually works. And once you see it, once you truly see it, you cannot unsee it. Let me take you inside the crypto market. The real version. Not the version you see on Twitter. Not the version the influencers sell you. The actual ugly, brutal mechanics of how money moves in this space. First, you need to understand one word. Liquidity. Liquidity is the amount of money flowing in and out of a market at any given time. In the stock market, the real stock market, with Apple and Amazon and Microsoft, liquidity is massive. Billions of dollars move every single day. Trillions even. That means when you buy a share of Apple, there are thousands of other people buying and selling at the same time. The price moves smoothly, predictably, rationally, mostly. Now, think about most crypto coins. Not Bitcoin, not Ethereum. The thousands of other coins that make up the vast majority of the crypto market. The liquidity is tiny, shockingly tiny. We're talking millions of dollars, sometimes less, sometimes way less. And here's why that matters. When liquidity is small, it takes far less money to move the price. A single large buyer can push the price up dramatically, and a single large seller can crush it just as fast. Now, who are those large buyers and sellers? They're called whales. And whales are not playing the same game you are. A whale is anyone with enough money to significantly move the price of a coin. In Bitcoin, whales might have hundreds of millions or even billions of dollars. In smaller coins, the ones most retail investors are buying, a whale might only need a few $1,000,000 to control the entire market. A few $1,000,000. That's nothing to a hedge fund. That's nothing to a venture capital firm. That's pocket change to the people who actually control where the money flows in crypto. And here's what whales do. They manipulate. Not sometimes, not occasionally, regularly. systematically. As a core part of their strategy, let me paint you a picture. Imagine a coin. A small coin. Decent project. Some real technology behind it. The price is sitting quietly at, let's say, $1. Not much is happening. Volume is low. Nobody is really paying attention. A whale decides this coin is interesting, so the whale starts buying. Quietly, slowly, not all at once. That would spike the price and alert everyone. No, the whale buys small amounts over days or weeks, accumulating, building a massive position while the market barely notices. Then the whale does something strategic. The whale starts talking, not publicly, not in their own name, through social media, through influencers, through chat groups, through articles. The whale creates noise around this coin, builds excitement, makes it seem like something big is coming. People start buying. Retail investors, regular people like you and me. The price starts climbing. $1 becomes $2, $2 becomes $5, $5 becomes $10, and everyone is celebrating. Everyone is excited. Everyone is posting about it. But the whale? The whale isn't celebrating. The whale is selling. Quietly, carefully, into the excitement, into the buying pressure, into the crowd, and by the time the retail investors realize what's happening, by the time the price starts falling and the panic sets in, the whale is already out. With your money, clean and simple. This is called a pump and dump, and it is not illegal in crypto. Let me say that again. It is not illegal. In the stock market, this kind of manipulation would land you in prison. The SEC would come knocking. Regulators would shut you down. The laws are there. They're not perfect, but they exist. In crypto, for the most part, they don't. The market is largely unregulated, which means the people with the most money have almost no guardrails, no rules, no consequences. They can move price wherever they want. And retail investors, the people with the least money and the least information, are the ones who pay the price. Every single time. Now, I know what you're thinking. Ray, I'm not going to fall for a pump and dump. I'm too smart for that. I do my research. I only buy the big coins. Bitcoin, Ethereum, the real ones. Fair enough? Let's talk about the big ones. Because the manipulation doesn't disappear with bigger coins. It just gets more sophisticated. Bitcoin has billions in liquidity, so no single whale can move it the way they move a small coin. But groups of whales can. Institutions can. And they do. Not through pump and dump schemes. That's too crude at that scale. They do it through something far more subtle. They do it through information asymmetry. Information asymmetry. 3 words. Write them down. It means one side of a transaction knows something the other side doesn't. And in crypto, the information gap between institutional players and retail investors is so vast it might as well be a canyon. Institutional traders have access to on-chain data, real-time information about exactly where Bitcoin is moving and who is moving it. They have teams of analysts watching whale wallets around the clock. They have algorithms that process millions of data points every second. They know, or can predict with reasonable accuracy, when large movements are coming before they happen. You have Twitter. You have YouTube. You have a phone app that shows you a number going up or down. That's not the same game. That's not even close to the same game. It's like showing up to a Formula One race in a bicycle. You're on the same track, but you are not in the same competition. And here's the deepest, most uncomfortable truth about this entire structure. The system isn't broken. It's working exactly as designed. Crypto markets were not built to make retail investors wealthy. They were built, whether anyone intended this or not, to transfer wealth from the many to the few, from the uninformed to the informed, from the emotional to the disciplined, from you to them. And the beautiful, terrible irony, most of the people losing money don't even know they're playing a rigged game. They think they're investing. They think they're being smart. They think their research and their conviction and their long-term mindset will protect them. It won't. Not without the right framework. Now, I have spent decades studying how markets work. Real markets, broken markets, bregged markets, rigged markets. And in all of that time, I have developed a set of principles, a framework for navigating any market, no matter how hostile, including this one, and I want to share it with you. But not yet, because before I give you the framework, I need you to understand one more thing. One more critical piece of this puzzle that David, the man from the beginning of this story, got completely wrong. It has nothing to do with which coins to buy. It has nothing to do with when to buy or when to sell. It has everything to do with how you think about risk. And most people, even smart, disciplined people, have no idea what risk actually means in the context of crypto. So stay with me, because in the next part I'm going to hand you the exact framework I use, the principles I follow, the rules I never break, and I'm going to show you, step by step, how to approach crypto without letting it destroy everything you've built. But I have to warn you, it's not what you expect. The Dalio framework, how to actually play this game. It's not what you expect. Because the first thing most people want to know, the very first question they ask is, which coin should I buy? And I'm going to tell you that question is completely wrong. It's like walking into a battlefield and asking, which weapon should I use? Before you've even looked at the terrain. Before you know where the enemy is. Before you understand the ground you're standing on. The weapon doesn't matter if you don't understand the battlefield. So before we talk about Bitcoin, before we talk about Ethereum, before we talk about any specific coin, we need to talk about something far more important. We need to talk about you. Specifically, we need to talk about your position, your size, your risk, and the single most important question you should be asking yourself before you put one single dollar into crypto. That question is this: how much can I afford to lose? Not how much do I want to make, not how much could I potentially gain. How much can I afford to lose? Read that again. How much can I afford to lose? Because here is the brutal, non-negotiable truth about crypto that I wish someone had told me decades ago when I first started studying speculative assets. In crypto, losing everything is not a possibility. It is a probability. Not for Bitcoin, maybe not for Ethereum, but for most coins in this market, the ones that promise you life-changing returns, the ones that have the flashy websites and the passionate communities and the roadmaps full of grand promises, losing everything is not if. It's when. So the very first principle of my framework is this: never invest in crypto what you cannot afford to watch disappear forever. Forever. Not temporarily, not for a dip, forever. If losing that money would change your life, if it would affect your ability to pay your bills, support your family, or retire with dignity, then that money does not belong in crypto. Period. Full stop. No exceptions. This is not fear talking. This is math. And I have never, in 50 years of managing money, seen math be wrong about this. Now, assuming you understand that, assuming you have set aside money you can genuinely afford to lose, the next question becomes, how much? And here's where most people get it catastrophically wrong. They think in percentages of excitement, not percentages of strategy. What do I mean by that? I mean they decide how much to put into crypto based on how excited they feel about it, based on how much potential they see, based on how much their neighbor made, based on how loud the noise is. That is not a strategy. That is emotion wearing a calculator. My framework is simple, and it will feel uncomfortably conservative to most people. Good. Discomfort is where discipline lives. Here is the rule. Crypto should represent no more than 2 to 5% of your total investment portfolio. 2 to 5%. That's it. I know what you're thinking. Ray, 2 to 5%. That's nothing. That's not going to change my life. That's not going to make me wealthy. You're right. It's not. And that's exactly the point. Crypto is not supposed to change your life. Crypto is supposed to be a small, calculated hedge, a tiny piece of a much larger, much more diversified strategy. It's insurance against a specific future. The future where traditional money systems break down. The future where governments lose control of currency. It's a bet on that future. But it should be a small bet, a measured bet. A bet that, if it loses, doesn't derail everything else you've built. The people who made real, lasting wealth from crypto, not the ones who got lucky in 2017 or 2021, but the ones who actually kept that wealth. They did it with small positions, disciplined positions, positions that were part of a larger strategy, not the strategy itself. The people who lost everything, they made crypto the strategy. See the difference? One group used crypto as a tool. The other group was used by crypto as a fool. Now, within that 2 to 5%, the next principle is diversification. And yes, diversification applies even inside crypto. Most people who buy crypto buy 1 or 2 coins and pray. That's not diversification. That's gambling with extra steps. My approach, and this is non-negotiable in my framework, is to spread that small allocation across a handful of assets. Bitcoin, Ethereum, maybe 1 or 2 others with genuine proven utility. Not 50 coins, not 20 coins, a handful. Because the more coins you hold, the more likely you are to get caught in a manipulation scheme. The more coins you hold, the harder it is to truly understand what you own. And if you don't understand what you own, you don't own it. It owns you. We already talked about that. So, small allocation, diversified within that allocation. Now what? Now comes the hardest part. The part that separates the people who win from the people who lose. The part that David got wrong. The discipline of knowing when to stop. Because here's something nobody tells you about crypto. The market will, at some point, make you feel like a genius. It will reward you so fast and so dramatically that your brain will scream at you to do more, to add more, to double down, to go bigger. And in that moment, in that exact moment, you must do the opposite. You must stop. Not because the market is about to crash. You don't know that. Nobody knows that. But because the moment the market makes you feel invincible is the exact moment your judgment is the most compromised. I learned this lesson the hard way in 1982. I made a bet on the economy that I was absolutely certain about. I was so confident that I put more money into it than I should have. The market validated me at first. Everything went exactly the way I predicted. And then it didn't. And I lost almost everything. Not because my analysis was wrong, because my position was too big, because I let confidence become arrogance, because I confused being right with being safe. There's a massive difference between being right and being safe. You can be right about crypto. You can be right about which coins will survive. You can be right about the long-term future of decentralized money. And you can still lose everything. Because being right doesn't protect you from bad timing. Being right doesn't protect you from a market that doesn't care about your thesis. Being right doesn't protect you from your own inability to hold steady when the numbers turn red and your stomach drops and every instinct in your body is screaming at you to sell. So the discipline isn't just about how much you buy. It's about how you behave after you buy. And here is the final, most critical piece of my framework. You set your rules before you enter, not during, not after. Before you buy a single coin, you decide exactly what you're going to do in every possible scenario. If the price doubles, what do you do? If it drops 50%, what do you do? If it drops 90%, what do you do? You write it down, you commit to it, and you follow it. Even when it feels wrong. Especially when it feels wrong. Because feelings are not a strategy. Feelings are how David lost 30% of his net worth in 6 weeks. Feelings are how millions of people turned hope into heartbreak. And feelings or how the market separates the disciplined from the desperate. Now, I have given you the framework, the position sizing, the diversification, the discipline, the rules, and on paper, it all makes sense. It all sounds logical. It all sounds doable. But here's what I haven't told you yet. The framework is not enough. Knowing the rules won't save you. Having a plan won't save you. Having a plan won't save you. Understanding the market won't save you. Not if you don't understand the one thing that will ultimately decide whether you win or lose in crypto. And it has nothing to do with the market. It has everything to do with you, the real battle. The one that matters more than any trade, any coin, any price movement is not happening on a screen. It's happening inside your head. I'm writing the final part now.